This is our WorldCom case presentation for Dr. Lorke's Accounting 521 Fraud Examination class. The group members are Laura Klein, Bailey Josephs, and Houston Harris. This presentation is narrated by Laura Klein. WorldCom's founding can be traced back to the breakup of telecommunications giant ACCT. Several small regional companies were able to gain access to the long-distance phone lines established by ACCT, which is how WorldCom found its beginnings. Founded initially as LDDS, which stands for Long Distance Discount Services, WorldCom began with just $650,000 in capital. Soon, the company found itself in massive debt due to the high demands and complex nature of its large accounts systems. The company named Bernard or Bernie Ebbers its CEO soon after. After a series of acquisitions of small local companies and mid-tier companies throughout the south and west of the United States and also internationally, the company went public after acquiring Advantage Companies, which was already publicly traded. After a shareholder vote in 1995, the company became WorldCom. And its largest acquisition, however, was MCI, the nation's second largest long-distance company at the time. The $42 billion takeover was the largest in U.S. history. Through this diagram, you can see the major players in the WorldCom fraud. Bernie Ebbers is the company's Chief Executive Officer, and Scott Sullivan is the Chief Financial Officer. Cynthia Cooper, highlighted in blue, is one of the main whistleblowers in the WorldCom scandal and was the company's Director of Internal Audit. Ms. Cooper's two assistants and vital characters in the story are Gene Morse and Glenn Smith, both managers in the Internal Audit Department. The two largest perpetrators of the fraud, Betty Vinson and Troy Normand, are both directors in the accounting department, headed by Buford Yates, who is supervised by David Myers, controller of WorldCom. As you can see by the organizational chart, Cynthia Cooper reports directly to Scott Sullivan, who reports then to Bernie Ebbers. In March 2002, Cynthia Cooper received a tip that Scott Sullivan, the company's CFO, may be using reserves to cover expenses. This tip came in the form of a visit from John Stupka, head of WorldCom's wireless division. Mr. Stupka had set aside $400 million to cover shortfalls from customers who did not pay their bills, which was a common and acceptable accounting practice. However, Mr. Sullivan had used the $400 million to reduce expenses and boost income, which is not an acceptable accounting practice. Mr. Cooper and her team, consisting of Gene Morse and Glenn Smith, decided to pursue the issue and dig deeper into the numbers. At the next meeting of the Audit Committee on March 6th, Ms. Cooper and Mr. Sullivan both presented their cases for why the decision to use the money for reducing expenses was unacceptable and acceptable, respectively. Mr. Sullivan backed down from his position at the meeting, according to reports. However, according to other sources, Mr. Sullivan tracked down Ms. Cooper personally and threatened her to keep out of the business of Mr. Stupka. The day after the meetings of the Audit Committee, the Securities Exchange Commission, also known as the SEC, served WorldCom a request for documentation because the company had reported profits while its competitors had reported several periods of losses. Concerned by this request and insistent on discovering the truth, Ms. Cooper conducted financial audits of the company, a practice that her department would not normally undertake. In April, the board of directors met alone for the first time, meaning they did not meet with Mr. Ebbers, the CEO, in attendance. By May 28th, Mr. Morse had uncovered $500 million of computer expenses that lacked invoices or evidence they had actually occurred. As the internal auditors were gathering more incriminating evidence, Mr. Sullivan suddenly called Ms. Cooper into his office for a meeting. When Mr. Sullivan was informed about the audits that Ms. Cooper's team was conducting, he instructed Ms. Cooper and her team to delay the audit until after the third quarter. Bravely and very importantly, Ms. Cooper refused. By June 17th and the days surrounding, the internal auditors had uncovered one accounting entry that lacked explanation: prepaid capacity. When the audit team inquired into the company, namely to Betty Vinson, Troy Normand, Buford Yates, and David Myers, about what prepaid capacity entailed, no one could give a straight answer. After weeks of gathering evidence, mostly working at night and in secret, with the assistance of WorldCom's new external auditor, KPMG, Ms. Cooper had gathered a case that WorldCom was committing fraud by capitalizing expenses into the prepaid capacity account to the tune of just over $3 billion. Finally, with her evidence prepared that the company was committing fraud, Ms. Cooper headed to Washington, D.C. to speak with the board's audit committee on June 20th. Mr. Sullivan was given the weekend after the audit committee meeting to prepare his defense of why the expenses were properly capitalized. After presenting his rebuttal through a white paper, the audit committee gave him two options: resign or be fired, because they had been convinced that he was an accomplice in the fraud, and was unconvinced by his rebuttal. By June 24th, Mr. Sullivan had refused to resign and was then fired. The next day, WorldCom announced that it had inflated profits by $3.8 billion over the previous 5 quarters. 2 days later, the SEC launched a civil suit investigation into WorldCom. Just under a month later, WorldCom filed for Chapter 11 bankruptcy protection, the largest bankruptcy filing in history at the time. This table provides a summary of the accounting fraud committed by WorldCom. The table shows the difference between reported line cost expenses and the actual line cost expenses. This difference was primarily taken advantage by the capitalization of expenses through the prepaid capacity account. Through the table, you can see that the capitalization of the fraudulent expenses amounted to significant differences between the correct and fraudulent totals, namely in the 10Ks for both 2000 and 2001 of almost $1 billion and $3 billion, respectively. In addition, this table shows the resulting income with the perpetrated fraud and without. This table shows the drastic difference that resulted from the fraudulent capitalization of line costs when it had come through onto the income statement. Incomes were reported as significantly higher when the fraud was perpetrated, even showing that the company made a net income in the second quarter of 2001 and the first quarter of 2002, when in fact the company was at a net loss. As shown here, the top table shows the summary of the capital expenditures that were reported to the board of WorldCom and those capital expenditures that were actually spent. Also, the bottom table shows the total number of improper reporting of revenue, line cost, and SG&A, which stands for Selling, General, and Administrative Expenses. In total, as seen in the bottom table, the company improperly reported almost $10 billion of revenue, line cost, and SG&A expenses. There are several factors that led to WorldCom's demise. First, the corporate culture was vastly amiss. WorldCom began as a company that expanded rapidly through acquisition. And therefore used that strategy to continue to grow. When a merger to acquire Sprint was disallowed by the Justice Department in 2000, WorldCom was at a standstill. Large-scale mergers were no longer a viable option for growth. Therefore, executives turned to other options to increase earnings, specifically through fraudulent activities. In addition, through the many acquisitions that WorldCom undertook, the corporate culture was made up of a hodgepodge of people from all over the country, making a cohesive culture with consistent policies a difficult challenge. In addition, company employees reported that WorldCom emphasized a systematic attitude that companies should not question their supervisors, making it difficult for employees to address their concerns. Second, there was immense pressure to achieve a target ER ratio. This pressure was heavily influenced through Bernie Ebbers' insistence on attaining the target ER ratio, which led his subordinates to fraudulently capitalize expenses in order to achieve this target ratio. Ebbers was also quoted as saying he wanted WorldCom to be the #1 stock on Wall Street. This drive to please investors and analysts can turn a company down a detrimental path. Next, the fraud triangle was highly evident in the WorldCom fraud. The perpetrators, namely Scott Sullivan and David Myers, had the opportunity through the prepaid capacity accounting loophole to commit and record fraudulent entries. They also had pressure due to the immense demand that the company meet its target ER ratio and the financial pressures of the dot-com bubble burst of the early 2000s. Sullivan and Myers also had rationalization that the fraud they were committing was not an issue because they believed that they had the accounting rationale to back it up. In addition, the fraud was encouraged by the blurring of the line between earnings management and fraudulent reporting. Earnings management, when done legally, takes advantage of accounting principles and regulations to make earnings more appealing, reduce riskiness, and enhance the company value. Fraudulent reporting, however, is the intent to deceive the reader of the financial statements with misleading information used to misinform the public about the company's position. The executives at WorldCom crossed the line between creatively and legally managing and smoothing earnings into the fraudulent reporting territory. Lastly, this fraud occurred because of the improper handling of the audit by Arthur Andersen. Arthur Andersen initially and incorrectly approved the allocation of $400 million of reserves to Mr. Sullivan instead of the proper use by Mr. Stupka, therefore creating a downward spiral in responsibility of Arthur Andersen to correctly audit the company. Arthur Andersen also did not comply with Ms. Cooper when she attempted to dig deeper into the potential fraud. Our group believes Arthur Andersen is partly to blame for the WorldCom fraud. Arthur Andersen became dependent on the fact that WorldCom was their largest client and protected the revenue stream for the firm by not pursuing fraud when it was brought to their attention. Arthur Andersen could have saved many people's retirement and investments by investigating fraud when it was brought to their attention, namely by Cynthia Cooper. Our group believes that the board of directors was not to blame. The board of directors met without Ebbers for the first time in April of 2002. This is almost a month after Cynthia Cooper received her tip about the fraud. Without Bernie Ebbers' interference in the proceedings of the board, employees like Cynthia Cooper may have been able to come forward with concerns much earlier in the process of discovering the fraud. Betty Vincent is a conundrum of sorts. She can be considered either a victim or a villain. She is partly a victim because she was pressured to commit fraud by her supervisors, such as Scott Sullivan. In fact, Ms. Vincent attempted to resign during the fraud, but was convinced to stay by Mr. Sullivan. However, Ms. Vincent can also be considered a villain because she perpetrated the fraud with the help of Troy Normand. She also had many opportunities to leave the company or report the fraud to the authorities. However, our group believes Betty Vinson is more of a victim than she was a villain. Finally, our group believes that Bernie Ebbers should receive the most blame for the WorldCom fraud. Mr. Ebbers had the most pressure to commit fraud due to the $400 million of loans secured by WorldCom stock. Therefore, the pressure for the stock to be the best on Wall Street was immensely high, leading him to convince his subordinates to cook the books in any way that would produce a favorable trading price for WorldCom stock. This fraud could have been prevented by earlier intervention by Arthur Andersen. However, Arthur Andersen was not in a place that encouraged them to investigate the fraud. WorldCom was Arthur Andersen's most prized client, which does not encourage Arthur Andersen to investigate or accuse fraud and potentially lose the client. Arthur Andersen, however, had plenty of opportunities to intervene in improper accounting practices when it was brought to their attention. In addition, this fraud could have been prevented if the employees had not been as intimidated to speak up and voice concerns to their supervisors. If those in the accounting department had not been coerced through intimidation to make the fraudulent capitalization entries, the WorldCom fraud may not have occurred. Another way this fraud could have been prevented would be by implementing controls on management. Ms. Cooper later described the adjustment of line costs as, quote, on top post-close entries, end quote, which means that management was able to close the books, compare the results of the quarter to Wall Street projections, and book accounting adjusting entries to make the difference. If controls had been in place to prevent these actions, the fraud may not have occurred. The company could have also restructured its financial goals to make them more realistic. According to achieving one specific ratio, such as the ER ratio, each quarter adds ample pressure for certain accounts to make the ratio feasible. If overall financial goals were adjusted to achieve overall company health, the WorldCom fraud may have been avoided. Immediately after the fraud discovery, almost 17,000 employees were laid off. Many lost some or all of the 401ks that they had invested in the company. In addition, WorldCom stock became effectively useless and worthless after the discovery of the fraud, and NASDAQ halted the trading of the stock. Finally, subcontractors and suppliers were forced to lay off workers or close due to the loss of contracts with WorldCom. As auditors and accountants, the most integral principle of our field is integrity. Cynthia Cooper and her team of internal auditors are great examples of how to conduct their professional duties with integrity. After being personally stalked and threatened by Mr. Sullivan, Ms. Cooper stayed the course of her financial audit of the company and helped to uncover the fraud. In addition to the intimidation Ms. Cooper faced, she also faced several ethical issues, including the possibility of betraying her company. She most certainly faced personal threats and losses of friends in the company through her actions, but she stayed true to her morals despite the consequences. Ms. Cooper, as an internal auditor, was obligated to the employees, stakeholders, and investors of WorldCom to ensure that the company was accurately portraying their business. Ms. Cooper was also responsible to the ethical code of conduct of a CPA, which she was licensed as, to investigate fraud and stop it in its tracks. Despite the ethical decisions she was forced to make, Cynthia Cooper stayed the course of investigating the fraud. Ms. Cooper could have turned a blind eye to the fraud or simply taken the answer she was given by Arthur Andersen or her superiors. But with courage and determination, she continued to investigate and uncovered one of the largest frauds in U.S. history. It is our group's belief that Ms. Cooper is in fact a hero and should be highly admired for her bravery and persistence under the most difficult circumstances. Here we have listed our sources that we used during the presentation. Thank you.